So there's a new tech IPO on the block, and it's in the red-hot EdTech space. Today, we're going to tear into the initial public offering for Excelsoft Technologies to figure out if the hype is actually real. Let's get right into it.
All right, the first number you gotta see is this one, 500 crore rupees. That is the total size of this IPO. And wow, that's a clear signal that this company has some serious ambition.
But a big number like that doesn't tell the whole story, does it? The real question is, what are you actually buying into with a company like this? That's what we need to figure out. Okay, so first things first, let's get to the core of it. What exactly is Excelsoft?
Well, Excelsoft plays in a very specific and very hot sandbox, educational technology. They're what's known as a vertical SaaS company. So think of it this way. Instead of making software for everybody, they make specialized tools for just one industry. In their case, that industry is the global e-learning and assessment market.
And look, we're not just talking about one single piece of software here. This is a whole suite of tools. We're talking AI-powered learning apps, platforms for online exams, remote proctoring, yep, that's the software that watches you take a test, and even digital textbook solutions. They're really trying to be the one-stop shop for modern education.
And get this, they're not just some local player. Excelsoft is already global. They've got 76 clients spread out across 19 different countries. This really proves their products have a broad international appeal.
Okay, so the business model definitely makes sense. But here's the real question. Is it actually making any money? To answer that, we have to crack open the books. Let's see what the numbers have to say.
All right, I know what you're thinking. A full profit and loss statement like this, it's a lot to take in, right? It's dense, it's complicated, so instead of making you squint at all these details, we're just going to pull out the two numbers that tell the real story here, revenue and profit.
So if you look at the revenue on the left, that's a pretty good story. It's growing nice and steady. That's a great sign. But the real drama, that's over in the profit column. See that? Solid profit in 23, then a big dip in 24, and then this huge, massive rebound in 25. So what's going on there?
And if you want to see that story in a single picture, here it is. You can literally see the valley in fiscal year 24, but then just look at that massive recovery in 25. This is that powerful turnaround that is everyone talking.
Yeah, to put an actual number on that comeback. After that dip, their profitability didn't just recover, it totally exploded. We're talking a surge of over 172% in a single year. Now that is the kind of rebound that gets investors' attention.
So with numbers like that, you can see why people are getting excited. Let's really lay out the case for investing, what the bulls are saying about Excelsoft.
All right, let's break down why people are bullish on this. First off, they're in the right market. EdTech SaaS is a huge growth area. They seem to have the right products, mature, AI-enabled tools, and they've got strong global clients, which means predictable recurring revenue. Plus, the timing is perfect. The demand for digital testing is just going up and up. It's a really solid foundation.
And they have very clear plans for that IPO money. A big chunk of it is going right back into growing the business. A new building, major IT upgrades, and this tells you something important. This isn't just keep the lights on money. This is about gearing up for the next big stage of growth. Okay, but it can't all be good news, right? Every investment has risks, and for this company, there's one major red flag that pops up in every single analysis you read. And boom, there it is. The single biggest risk, nearly 60% of all of Excelsoft's revenue comes from just one client, the Pearson Group. Anytime one customer makes up that much of your business, it's a huge client concentration risk. And this is a big one.
And hey, don't just take my word for it. The Economic Times calls this a meaningful client concentration risk. I mean, just think about it for a second. If anything happens to that one single relationship, it could seriously damage the company's bottom line. This is the #1 concern for every analyst looking at this IPO.
Now look, beyond that one huge issue, you've got the usual suspects for a company like this. Cybersecurity threats, the headache of dealing with regulations in 19 different countries, and just the weird cash flow stuff that comes with a subscription model. It's standard stuff, but still worth keeping in mind.
So, what do we have? We've got a growing business, but with a giant risk. How do you balance that? Well, let's turn to the market experts and see what they have to say.
Ultimately, this all comes down to the price. Excelsoft is asking for a valuation of about 35 times its earnings. That's its PE ratio. And when you compare that to its peers, a PE of 35 puts it right at the pricier, more expensive end of the scale. And because of that, the consensus among analysts is pretty clear. You keep hearing words like demanding and aggressively priced. What that really means is they think the price is so high that all the potential good news is already baked in, which leaves very little room for a big pop on day one. And this quote from Swastika InvestSmart really sums up the whole expert consensus. They've slapped a neutral rating on the IPO, basically saying that because the price is so aggressive, investors should only expect a minor gain when it starts trading, if they get one at all. So let's boil it all down, shall we? Excelsoft looks like a strong business, no doubt, and it's in a great growing sector. That's not really up for debate. The debate is whether that strength is worth swallowing that massive client risk and paying the very premium price tag the experts are flagging. And that really leaves us with the big question you have to ask yourself. You've got high growth potential on one side, but high risk on the other, all wrapped up in a premium price. So the question isn't just, is this a good company? It's, is it a good investment for you?